All right, so this is where the fun begins. So this is an advanced section of my inversion model, starting with the basics, and I'm going to go over good ones, bad ones. I'm going to go over a lot of things. So probably going to split this video into two parts, but pay attention. You might have to watch this a few times. And as always, this is going to require a lot of experience as well. So you're going to need to learn these, and then you're going to have the experience, and then that's what's going to help you the best. So inversion fair value gaps is my best win rate model ever. Okay. They're very good. Okay, I'm gonna be going over what they are, how to use them. So the pros, they have a very high win rate. Okay, they can be used both for bias and entries, which is cool because you really can't use a lot of other models for both. Um, the market, again, after we trigger an inversion, the market tends to accelerate much faster. So it's like it's like a less emotional stress because the market accelerates faster after we inverse something. So it's like nice to get in, and the target usually hits faster than if we like dance around in like a fair value gap and you're taking a 2022 model. All right, so the cons, the risk reward can be tough, and it can be tough to figure out depending on how you do it. So I'll talk about this later, but um, sometimes the risk reward isn't great. You can definitely avoid the bad risk reward ones, even though they'll probably still work. But again, I've seen a lot of inversions work, but the risk reward just isn't there. So I watch them play out, and I don't FOMO in, and yeah. And again, the other con is there's lots of inversion setups. There's a lot of bearish fair value gaps that violated. There's a lot of bullish fair value gaps that get violated. Um, and that's what an inversion setup is. All an inversion fair value gap is when something gets violated. But it's going to take time to identify the good versus the bad ones. Okay, so the last important thing is, when should you expect inversions to form? You should expect them to form after liquidity sweeps. Okay, if we sweep below, why would you expect a bearish fair value gap to reject? This is the number one principle when learning inversions, okay? When you're looking at the chart and you see us sweep some sort of low like this, okay? Why would you in any way expect this bearish fair value gap to cause price to reject? You wouldn't, right? We swept so much liquidity. We're delivering from a bullish fair value gap down here, right? There's no need. This is not the 2022 model because we already ran stop losses down here, right? And that's when you're going to get an inversion fair value gap. And if you don't understand that, you're going to have a hard time identifying these, because a delivery from a fair value gap or a liquidity sweep is key to identifying these. All right. You need to understand when an inversion is going to actually be inversed. Okay, now, sometimes you'll see, okay, we do inverse this and we do run liquidity. But sometimes what happens is we actually do reject from this, which means, one, either price action's bad, it's a bad time, it's not a kill zone, whatever it may be, or two, where there's probably more like equal lows or something you're missing below or something like that. But that doesn't matter because you're not going to take the loss if it doesn't inverse anyways. So again, that's little disclaimer. You need to understand liquidity and understand, okay, if we sweep below, you shouldn't see a bearish fair value gap reject. And if we sweep a high, you shouldn't see a bullish fair value gap work. So here we sweep this high. Why would you expect us to cleanly bounce off a fair value gap like this? Okay, this is when you're expecting an inversion to form. All right. So whenever I mention the words BE on the slides, it just means stop loss to break even. BE means break even. Okay. An inversion fair value gap should form based on liquidity. Exactly what I just talked about. Okay. So I'm going to go more in depth in this. Okay. But before, it was a little my disclaimer. But if we hit hive day and form a bullish fair value gap, it would not make sense for the bullish fair value gap to be bounced off of, because we already purged some sort of liquidity. Okay. And you need to understand that if we purge buy side, why would we bounce off a bullish fair value gap? We wouldn't. If we dump 100 points and hit equal lows from 2 days ago or whatever it may be from, should we expect a retracement to reject right away? No. Okay, you should not expect the first bearish fair value gap we see to reject, because if we swept equal lows, right, you're not going to expect that to reject. Right? If we already purged stop losses, we should not expect a retracement to reject or bounce off a fair value gap when you look for the inversion model. Okay, you need to be understanding inversion fair value gaps in terms of liquidity. A great example was the other day. Okay, we had very obvious equal lows down here. All right, very obvious. Now, if I go back to the chart, when we hit these equal lows, we have a bearish fair value gap. Okay, right here. And what do you notice? We have a bearish fair value gap here. Price, after you hit these equal lows, it does reject it. But is this a good play? No. You want to use this when it turns into an inversion. And because we swept equal lows, most likely price is going to use an inversion. Same thing as here. Okay, you can see we swept these equal lows. You would not expect price to reject this because if we swept liquidity, you should not expect a rejection here. Okay, so we have this one that fails, and then this one actually works for a little bit, but then boom, look what happens. We just go right back to it, we trade right back to it, and then back to the high we go. Okay, I know we end up going down later, but initially you can see, and we do go down later again because the higher time frame was still bearish, but you do not want to be taking bearish setups or bearish fair value gaps after you swept some sort of liquidity. You have to wait for us to sweep liquidity again to the upside, for example, like this high, and then you can short again. So you can clearly see we swept sell side here. You would not expect this bearish fair value gap to work. You would not expect this bearish fair value gap to work. You're waiting for it to turn into inversion, and that's kind of what you're looking for. Okay, you don't want to see the market in terms of inversions. You want to see the market in terms of liquidity. Okay, that's going to serve you the best. So this is a perfect example of a bullish fair value gap we should not expect to work because we just hit high of day. Okay, why would we long this if we are already above high of day and we're also on premium? Okay, and I talk about premium and discount in another video. And we have triple equal lows below. Okay, so we have triple equal lows below. Okay, and if we do bounce off this, I don't care. It's still not a good play. You're not gonna see this work for a bounce all the time. Okay. The only way we bounce off of it is if I'm missing information. If let's say the draw is still bullish and I didn't know that, we'd probably bounce off of it, but it's still not a good play because I should have been long down here. All right, so this is a fair value gap that I would always expect to either wait for it to be turned into an inversion if I think we've hit all the liquidity we have to the left. Okay, so again, we do not look to see this fair value gap act as support. Sometimes it will. That's fine. We don't want to trade it. We just wait till it gets broken. Okay. And the nice thing about this one, it's a singular fair value gap. All right. Equal lows below. There's nothing else that says, okay, if we inverse this one, will we bounce off anything else? No, there's no other fair value gap here to bounce off of. So the next slide is going to be your actual model. Okay. It's going to be like the blueprint. It's literally everything you need to know in what I'm going to be talking about, and it's the core of the strategy and the signature I look for. So with no bias, using the inversion model is about a 60-70% win rate. And I've actually seen someone backtest over 50 trades. They literally just did every inversion from 9:30 to 11, I think it was, or 9 to 11, and they actually had an 81% win rate. So, and that was just them selling everything at the internal high or low. And I think it was actually an 85 because FX replay faults, but they had like an 85. So with no bias, it can be high. However, his risk reward just doing the 9 to 11 is every inversion, it was actually just, it was horrible risk reward. It was like a 0.4, which is obviously very negative. But the account was still profitable. It was up like 50% in a month from him doing it. So, I mean, it's profitable, but you have to be very, very, very careful because you have to go for a decent risk reward still. I know there's a lot of inversions that are going to be negative RR that are still going to work, but you should probably stay out of those in my opinion. So using the inversion model with bias is what I do, is a 80 to 90% win rate, and you have to be still following the signature and price. So I show you how to find bias in this course. I show you how to find market maker models, right? Using internal and external liquidity. Okay. And that's where I'm looking for inversion. So I'm looking for the market maker model first. I'm looking for the bias using an inversion on the higher time frame, and then what I do is I go to the lower time frame, and that's when I look for the model. So earlier was just a great example. Earlier we were inside of a 15-minute bullish fair value gap, and when price held it, I saw in the 3-minute we held it. Okay, we formed a 3-minute bearish fair value gap. So again, all I'm doing is I'm looking for some sort of fair value gap or whatever. It could even be an inversion, okay? And then I'm going to lower time frame, looking for a broken fair value gap, and then along to the, this is the guaranteed high I called it, but then I'll like try to hold runners to like here and then here, whatever it may be. So like that was a great example of what happened today. I show you how to find bias in the course using that. And again, 60% to 70% of the time, it is obvious, but there's going to be times where you're not gonna know the bias. And if you don't know the bias, what you want to do is you want to go in scout mode and you want to wait for like equal highs or equal lows to form. So, or even just something like this. This is just a simple inversion model where you don't need bias for. You see we clearly sweep below. You see we have an inversion fair value gap. The bias was bearish, but this works anyways, okay? Like you can see we dump later and the bias was bearish, but what happens? It still ends up working. So you don't need a bias technically for some of these setups, but typically if you want a higher win rate, you should be knowing the bias, all right? Which is going to take you a little time. So, yeah. So this is the model. I'm not going to, I mean, I think I will actually go over this so you guys know, but so you can see I have it all numbered out and stuff, but you're typically looking for some sort of sell side here, or you're looking for some sort of, let me move this actually a little bit. You're looking for some sort of higher time frame PD array here. So you're looking for a fair value gap here. Maybe it's on the 1 hour. Maybe this is the 1 minute chart and we're inside of a 1 hour fair value gap. That's what you're looking for. And your goal is to look for an inversion. So the number 2 is an inversion. This is a bearish fair value gap. And you're looking for a close. Are you following me? You're looking for a close above that bearish fair value gap. And what ideally you want to see is usually we'll have some sort of internal high up here. And ideally you want to see us close above that inversion without hitting the internal high first. And what this allows you to do is if you don't know the bias or your bias is wrong, typically we'll hit that internal liquidity after something is inversed. And if your bias is wrong, we'll hit that internal liquidity and just dump. So I have a little break even method or scale method I do, which I'll show you guys. But typically, unless you're very, very confident in the bias, you do not want to long an inversion after you already hit internal liquidity. And this is the main problem people have understanding with this model and what they don't understand. So this route I typically do not take unless I'm very confident about the bias. What would make me confident about the bias? Well, maybe we're trading inside of a discounted area on the higher time frame, and maybe there's perfect equal highs above. Okay, that's the only time I'll maybe take an inverse even after we hit internal liquidity. But 89% of the time I typically don't. All right. So I'm looking to play this black path. Okay. There must be a sweep. Okay, this is the actual bearish fair value gap. This leg right here does not have to be a bullish fair value gap. It is better if it is sometimes, and it is a BPR sometimes. So I will go over a BPR and the difference, but I'm not going to spend too much time on that. This could be a balanced price range, meaning we could get a bullish fair value gap lining up with a bearish one, but it's not necessary. We don't need a bullish fair value gap here. All we need to do is inverse this bearish fair value gap. No matter how we do it, we just need to close back over it, okay? So what I do, number 5, is usually when I'm in, I'll scale half at this internal high if it's more than 10 points. Sometimes it's only going to be 5 points. Sometimes it'll be like 20 points. But I'll usually scale half if it's more than 10. If it's not more than 10 points, I typically put stop the break even. And I'll look for like some liquidity above. Okay, so let's assume this is 5 points from, let's say, enter in the close. I don't wait for the retrace here, but we retrace anyways. Let's say enter in the close, and this is 5 points. Well, I won't sell. I'll just move south to break even. And depending on your entry, the more you market buy or market go in and not wait for the retrace, the more you're going to get south to break even, which is fine. But it's still the same win rate. So it obviously depends on how close we are to internal liquidity. If we close above a bearish fair value gap and we're really close to internal liquidity, you're probably going to get south to break even. But if the close is down here where my mouse is, or you're taking the retrace, and we go all the way up to this internal liquidity, you typically will not get stopped at break even if your bias is right. So that's one thing to think about. Some of these setups are just not worth taking because they're so close to internal liquidity, and you're probably going to get stopped to break even anyway. So I'll show you a couple examples of that. But again, the candle must close over. It doesn't matter if it wicks over. The candle body has to physically close over. And yeah, so again, and then number 6, if the high hits here first and then we go down, I will not long it. Okay, it has to be a close above. So study this. This is gonna be your best friend for the next whatever, how many weeks or months. So yeah, and the inversion, the other thing I want to say is the inversion we use does not actually have to sweep the actual sell side. We could get an inversion under the sell side as long as some candle swept the sell side. That's fine. Like the inversion model could be right here, and the actual bearish fair value gap we're entering off of that is inverse does not have to be the one that swept the actual sell side. So that's another thing to note. So regarding bullet point 5, I already kind of talked about this, but if it's 10 or more points, I'll usually scale. If not, I'll put my stop to break even. But it's up to you, okay? I don't like under 10 points because it's just that I want more than 10 points. It's just how I work. 10 points is 10 points. Double digits, it's just how I trade. But it's up to you on how you want to scale, right? So it obviously depends on the condition of the day. So if I see clear seek and destroy conditions, okay, like hopefully you guys could have read that last side, by the way. If it is clear seek and destroy conditions like it was today, in the morning, so you can see this morning, just these were major scalping conditions. I will take off at like 7-8 points. Only if we're in these conditions and it's very obvious. Okay, I will take off at 7-8 points. Okay. It's hard not to because you're like, oh well, we just inversed so many things, like we're not gonna get a price action. Like sometimes if it's 7-8 points and I see this price action and I know it's NFP tomorrow, I know it's whatever the next day, or maybe JPOW speaking, I will maybe scale 7-8 points, but typically I do not do that. Okay, just really depends. Okay, I know the market has to hit a trail high, so it's like I know I'm gonna get 6 or 7 points or whatever it is. So it's nice, but at the end of the day, do you want 6 to 7 points or do you want to try to hold for more? Typically, I'm trying to hold to a little more. So I know the internal high usually gets hit. Okay, most of the time it will hit no matter the bias. So it's like it's a guaranteed target, I call it. Obviously, it's not going to be guaranteed 100% of the time, but it's not worth scaling there sometimes for RR, because if you do take a loss, it's probably going to be much worse than the win. And if you don't scale, just make sure you do move your stop to break even, as it is a free trade at that point, right? And again, what I will say is this: with Forex, it's, if you're a Forex trader, the break even thing is iffy. I've seen a lot of Forex setups work out where I would get stopped to break even personally. I think this is better for NQ mainly. Forex, experiment with moving the stop to break even, but I would maybe not move the stop to break even for Forex and just see how you do without it. And then yeah, so Forex, you're gonna just have to back test yourself for sure. And like I said, you might want to not put yourself at the break even for Forex, because Forex, especially outside the kill zone, is just much more choppy than NQ. So some trades you will scale a half internal and then it will trace back to your entry, and you will get stopped to break even and it will keep going back up. I've experienced this so many times where normally the times I experience this are, let me see. Is there a 30-second inversion here? All right, there's no 30-second inversion here, but let's say there was. Okay, right here, this is a perfect example. So in this example, we have an inversion here, we have an inversion here, and we have an inversion here. Now, because there's too many in the leg and it's not a singular one, I want to take it. But let's say I was confident about bias. Well, then I'd wait for the last one to break and then I'd take that. So let's say the candle closes above. I take the entry. And then we hit the internal high. Right? We hit the internal high right here. So I take the entry, whatever. My stop loss is obviously this isn't a realistic stop loss, but your stop loss would have to be basically a close below the last one because, oh, what if we bounce off this one and go to this one and then bounce, right? You don't know. That's why I don't like taking the singular fair value gap. That's why I need a singular fair value gap, not like a bunch. So let's say you take this trade, you take the close here, and then you move your stop loss to break even here. Depending on your entry, a lot of times if your entry is very close to this high, we will pull back like a little bit and you'll get stopped and it will keep going up. So that's going to happen sometimes, and that's fine. It happens more in other months than some months. So it definitely happened a lot more to me in December, and it'll definitely happen a lot less to me in the summer. Just it really depends on the month, depends on the price condition. So I think overall it's very profitable. So it's really going to depend on what month it is, what the conditions are, and etc. So just be paying attention to that. It's going to take you some screen time to figure out. So this will only happen if the candle close was really close to internal liquidity. And I will pass those setups up sometimes. Like, I'll show you an example. This was the 2 minute earlier. Okay, I actually did take this. So the 2 minute, see how close this candle close was to the high? If I enter on the close here, I'm almost guaranteed. So if I enter here, I'm almost guaranteed to get south to break even, because if I'm entering on the close here, because it's an internal or fair value gap, we still have not hit the internal liquidity here, as you can see. Okay, if I enter the close here, I'm almost guaranteed to get south to break even, because we're going to wick up here and then I'm going to get south to break even. But if I enter in the retracement, there's much less of a chance. However, it's not always going to give you the retracement. So I prefer entering in the close unless it's way above and the risk reward is awful, then I'll wait for the retrace. And I'll go over that in a little bit. Again, some days will be better than others on the break-even kind of condition. So the first example here, it shows where I would scale half and not get south to break even. Okay, there's almost no drawdown in here. There's literally no way to get south to break even in here. So we're delivering off an hourly fair value gap. Price clearly closes above. It's a nice close because it's not super high. It's not super like low. It's like a nice general close. And then I target the next intermediate term high, which I talk about in my liquidity video. So this is the intermediate term high right here. Okay, target that. But you can see there's no chance you get stopped out of break even here. So it will, like, this method is good. Okay, just sometimes it's going to stop you, sometimes it's not. This one, no matter where you entered, you would have gone south to break even, use my method. Okay, so you can clearly see this one. You can see there's a textbook inversion here. All right, my entry would be a close under because we had not had internal liquidity. All right, we retrace a little bit, and then I'd scale half here, assuming it's 10 points, and then I hold the rest to some sort of lower low. Now, you can see once I scale half, price comes back up to the internal liquidity right away and stops me out. And even if I did wait for the retrace here, even if I top tick the retrace, you would have still gotten south to break even. Okay, a lot of times this won't happen. We won't get an entry and then we come back up and then we go back down. Typically, if we come back up, it will fail. Okay, but there's still like, that's only 70% of the time. So 30% of the time it's still going to work, but I don't like to take my chances. All right, because I would rather be a free trade and be alive for more of the day. Okay, so the only time I do not move myself to break even is again, if I'm super confident in the bias. Maybe I was confident in the bias here. I'll just keep my stop above this inversion and just I would be in drawdown. That's fine, but you have to be very confident about the bias to do that, which is going to take definitely a lot of experience. So this shows an example where you don't get south to break even. This shows an example where you do, using my method. Okay, but again, if you're Forex or whatever, you don't have to do this break even method. This is optional. You're gonna have to backtest and see what works best for you. I prefer this method. So I usually market by the close, like I said, but that's only if the RR is decent. So in this example, you can see we have a clear inversion. We close above right here. Close above, and I'm market buying that close. This risk reward is still pretty good for me, so I don't need to wait for a retrace if the risk reward is already good. This example, You do not want to market buy the close because this is such a big zone. It's such a big stop loss. I'd wait for the retrace here for sure. This is too risky to buy up here because it's just, yeah, the risk reward is just, it's not even the risk reward. Like a 1-to-1 risk reward is fine, but it's just the size of the zone is just massive versus this is much smaller. And a lot of people don't want to take this much drawdown. So I would wait for the retrace here rather than taking the market close. And that's going to be something up for you to judge. So in the second example, same example here, but in the second example, like I said, I would move my entry down here. Well, remember, this will not always hit, okay? A lot of inversions I see don't come back, okay? And that's fine. Just move on, wait till the next trade. That's it. It all depends on how comfortable you are risking for the setup, right? Some people don't like the risk. Some people don't mind it, okay? It's up to you. So here's another one where the risk is just, it's horrible if you wait for the close of the high. And this setup actually would not be valid because we hit the internal high first. So this wouldn't be valid. But let's say you were very confident in the bias. Well, then I would long here because if I knew the bias is bullish, I would still, I think it's worth a try. Still a decent win rate if you're good at finding bias. So in this one, again, I would actually move it down to a retrace. You can see this is the bad one, and then this is the good one. So there's actually two RR boxes here if you can't tell. This is the good one, this is the bad one. And again, I would move my stop. I would just move my I would do the retracement here just because of how bad the risk reward is initially and how close we are to the high. And actually what I do is, this is a big zone, so what I do is I actually wouldn't market buy in the retrace. I'd go to the lower time frame and I look for a confirmation setup. And make sure you watch my confirmation video setup to know what that actually means. So inversions, they're best used during London and New York kill zones, but I only use them in New York kill zones. Okay, not great in Asia. Best used during London and New York kill zones. I only personally use them in New York because I'm sleeping in London, so that's literally the only reason why. I look back at London and I don't love it most days anyway, so I don't even think I'd trade London even if I could. I just don't find it as clean some days. So my goal is about 2 to 3 wins per day. When I live stream to my private Discord, I try to only take one just to be more disciplined with them, but I tend to maybe sometimes take another setup on myself or whatever if it's really good. And then I usually stop. I don't really go above 3 trades a day too much unless I'm on a demo account just practicing. If I hit 2 losses, I'm done for the day. That is it. I'm shutting down the account. I'm done for the day. And again, usually the 2 losses is a set amount. So if I'm on a 50K account and I'm risking 150 per trade, usually I'm down 300 at that 2 losses. And that 300 is my max drawdown. So it also going to depend on your rules. You're going to want good rules for this, all right? And then I have a slide called funding. I have a video called funding. I show you guys what I do for sizing on a prop firm account. And that's going to connect with what this 2 losses might be. It might be $500 on a 100K account. It might be 300 on a 50K account. Just depends on the account you're on. Or if it might be like 1,000 if you're trading a personal account. Maybe you're a billionaire. It might be $10,000 loss is you're done for the day, okay? So that is going to be it for part 1. I'm going to have a inversions checklist question. So this is going to be part 2. I'm probably going to have to make 3 parts because this is going to be a lot. But this is going to be the thing I'm going in the next video. And there's going to be no assignment yet. There will be assignment after all 3 inversion videos I do. But yeah, without further ado, I will see you guys in the next video.